Hello, everyone. My name is Sean Hunter, and I'm an industry fellow and director of inclusive growth programs at the Griffith Asia Institute in Australia. It's my pleasure to introduce today's session, which is titled Co-Designing Solutions for Unlocking the Potential of Digital Financial Services in Asia. This session is based largely on a major research project which the Griffith Asia Institute is currently undertaking with our partners, the Asian Development Bank Institute and MicroSave Consulting, and with funding support from the Citi Foundation. So this session will explore the potential transformative impact digital financial services can have on the lives of poor consumers in Asia, and focus on the challenges of helping disadvantaged populations understand the benefits of digital financial services. The presenters will highlight important steps necessary to enhance the prospect of achieving financial inclusion through digital financial services, and importantly, how such efforts can maximize their positive impact on the poor in developing Asia. So I'm honored to be joined by three of my expert colleagues today who will each present on a different aspect of our work together. First, we'll hear from Dr. Samir Deshpande, Associate Professor at Griffith University, who will speak about the importance of co-designing digital financial solutions for the poor. Following Samir's remark, we will then hear from Ayushi Mishra, who is a Senior Manager at MicroSave Consulting. And Ayushi will outline some specific strategies for enabling poor consumers to maximize the benefits of digital financial services. And then lastly, we'll hear from Dr. Peter Morgan, who's the Senior Consulting Economist and Advisor to the Dean at the Asian Development Bank Institute. Peter will wrap up the session by providing an overview of the role of international agencies in enhancing the potential of digital financial services in Asia's emerging markets. So before we get into the presentations, I'd like to spend just a few moments to provide a bit of background and context. So it's clear that digital transformation has and continues to have a significant impact on economies across the world. Some of the benefits of digital adoption and integration often touted include the creation of new business opportunities, improved public services, increased productivity or efficiency. However, digital transformation also brings new challenges, such as disruptive technologies leading to job losses, privacy issues, or the growing digital divide, which risks exacerbating income and wealth inequality. The digital divide became especially apparent during the COVID-19 pandemic. So in the wake of lockdowns and social distancing measures, governments and the private sector rushed to implement remote services that would enable economic activity and continue to ensure people were able to access essential services. But the value of these services was limited to those who not only had access to them, but also had the skills and knowledge that would enable them to use them safely. As technology continues to play a larger role in our societies, the digital divide is becoming clear, especially for the poorest and most vulnerable segments of society, which are less capable of taking advantage of technology. Since the pandemic, digital transformation has been viewed as an opportunity to not only rebuild economies, but also as a way to ensure a more resilient future that would help mitigate the impact of future shocks, as technology is increasingly recognized for its potential to drive more sustainable economic growth. Ensuring that this growth is equitable by closing the digital divide has become a major priority for many governments in the region. One of the significant contributions of digital transformation, and which is being widely promoted for its potential to drive inclusive economic development, has been the birth of digital financial services. Propelled by the rapid increase in mobile phone ownership across the region, digital financial services have become one of the most hyped innovations, including for its potential to address financial exclusion. Indeed, the latest Findex report from the World Bank identifies the rise of digital financial services as one of the most significant factors driving increased access to formal financial accounts. And so while there is much to be excited about with digital financial services, many challenges still remain. Importantly, we need to achieve a deeper understanding of what factors influence the adoption of digital financial services, as well as increase our understanding on how the poor interact with the digital economy more broadly. While there is a growing body of evidence to support the notion that the promotion of digital financial services leads to greater financial inclusion, data on how digital financial services impact the lives of the poor is lacking. And so with this backdrop, I'll now hand over to our first presenter, Samir, for his presentation. Thank you.
Thanks, Sean. When we are designing strategies for digital financial inclusion, especially in countries that are distanced from those who bring the financial funding, it's important that we resort to co-designing solutions with the segments whom we are trying to convince to adopt digital financial services. So my job here in the next 7 to 8 minutes is to discuss why co-designing is important, what it is, and what are the 7 steps one should embark upon when conducting a co-design activity. So what is co-design? As Sanders and Strappers in their 2008 publication define, co-design is a special instance of co-creation where we involve all kinds of diverse stakeholders into an activity, a workshop, or a discussion where we all come together, we iron out the differences, arrive at areas where we can agree upon, and think of solutions that almost majority of the people are willing to adopt in order to implement and evaluate the solutions for digital financial services. There is ample research now coming up which has clearly showed with evidence that co-design is a very useful activity. Here's a list of all the benefits that organizers, social change agents will receive if they genuinely carry out a co-design activity with the diverse stakeholders in the community and those who are affected by it before deciding the solutions and implementing and evaluating it. So some of the benefits include improved decision making, enhanced creativity and innovation, empowerment and ownership from those in the community who are going to adopt the solutions. There's a reduced risk of failure because there's a higher buy-in from the community. Needless to say, increased engagement from a variety of sectors. It's not a top-down approach anymore when you do co-design activity. And because the solutions are coming from the ground, the solutions are better. They're solving the problems in a better and more efficient manner, resulting in better quality outcomes. Which of course results in stronger relationships between stakeholders and those who bring funding and various solutions for the problem. And of course, all that then results in faster adoption of a variety of behaviors, including digital financial services, among the low-income sections of the society. Word about how co-design varies from a focus group. Focus group is a more well-known and more better practiced research activity around the world in a variety of sectors. However, of late, people have come to realize that focus group has some limitations. The biggest limitation being that it's more of a top-down approach where people, the social change agents, approach the communities to take feedback on solutions that have already been decided by the funding bodies and the social change agents. And all we are doing in a focus group is taking feedback from, let's say, 4 kinds of solutions and arrive at one solution that's going to be most adopted or most accepted by the people in the focus group for the actual implementation. So the solutions are created by the people who are funding and who are implementing the solution, while in a co-design workshop and a co-design approach and a philosophy, we're talking about solutions that are actually being created with the help of the community. So it's more ground up approach. It's not just an activity to be honest, it's a philosophy that we adopt throughout the process. As a result, the solutions, as discussed in the previous slide, are better, more efficient, with better engagement, and hence resulting in better adoption and outcomes. One more thing I forgot to mention in the previous slide is that in the focus group, we tend to bring homogeneous groups of people together in one room. So for example, if our target audience is men and women, we do focus groups only with women or only with men. Whereas in co-design, the objective is to bring diverse stakeholders together so that we get opinions from diverse sets of people and we arrive at a solution that is agreeable to the diverse stakeholders. Anyway, so moving on, the last part of my presentation is to talk about the 7-step co-design process that is normally used to carry out a co-design workshop. You will find that there are many kinds of models available in the literature for conducting a co-design activity. And by the way, I just want to clarify that co-design is not just one set of activity. It should permeate your entire process of carrying out the behavior change, solution designing, implementation, and evaluation process. So it's not just something that you do at the start and then you forget about it. It has to, the approach, the philosophy has to be utilized throughout the process. But in this case, the 7-step process is more about if you were to do an activity, what kind of steps will you carry out? So there are many models available out there. I'm presenting to you one of them presented by Trishler et al. 2019, which talks about the 7 steps. I will very quickly go through each step in the process. The first step in the co-design activity is the activity that you carry, or the step you carry out before you actually conduct the co-design workshop. It's called resourcing and planning. Needless to say, you need lots of resources, good amount of resources if you want to do a good co-design activity. It of course means money, but also a lot of non-monetary assets. Like you need a talented team who has bought in to the co-design approach and philosophy. You need a team that can carry out research before you conduct co-design research, and I'll talk about very quickly about what that research activity would be. You of course need a good facilitator, but with the facilitator you also need sub-facilitators, because you will have in a room with, ideally you want 15 to 20 people in a room with the participants, but they are all distributed with 4 people at each table. So you would have around 4 tables in an ideal scenario. You need a sub-facilitator at each table. Okay, so that requires someone to give the feedback from the table to the larger group to the main facilitator at the end of the brainstorming process. You also need partners who are willing to fund, pay, work with you to do research, give you feedback, give you more insights when you are drawing upon what to facilitate, what points to discuss. So in terms of planning, you of course need to plan for the day, for the session, with usual activities like you need to have a good network to recruit people, you need to have a time, you need to have a venue, you need to promote it very well, you need to provide incentives to participants to attend the workshop. Usually in countries like Australia, the going rate is $50 to $100 per person for their 2 to 2.5 hours of workshop activity. You of course need to create co-design materials, and you also have to have a nice design, a discussion guide to guide the entire activity, the entire session. One of the important activities in the resourcing and planning stage is to conduct a set of research activities to learn more about the topic, to learn more about the community, and to learn more about what solutions have already been tried before, so that we can think of those 7, 8, 10 solutions that have been tried before, may have shown effectiveness in the same community or before in other parts of the world, and then those solutions then could be brainstormed. A feedback can be taken about those solutions in the co-design workshop. So to come up with a list of these insights and these potentially effective interventions, we conduct systematic review or meta-analysis, which can take up to 3 to 6 months to conduct. We conduct expert interviews. These interviews could be with experts that are spread around the world, but they know something about the topic. And then we also conduct surveys in the community itself to get some preliminary idea on their perceptions, their experiences, which then could be further developed and detailed in the co-design workshop. In the remaining 5 steps, I'm going to focus on things that you do just before and during the co-design activity. So that step 3 is to recruit people. It's important to involve local partners when recruiting co-design participants. As I said before, you need 15 to 20 participants at each co-design activity. So expecting some people not to show up at the event, you need at least 20-25 people to say yes to attending on a certain day and certain time. We have realized that Thursday evenings and Saturday mornings tend to be the most convenient time for most participants, at least in the developed societies. I'm pretty sure that similar insights could be gathered from other parts of the world, depending on when their holiday lies and when are they most available. So again, use local partners to carry out the recruitment process through their own networks. As I said before, in a co-design activity, you need to ensure that you get diverse set of stakeholders. Within target audience, you need to ensure that you get some diversity in the kind of people who attend your co-design activity in each of those workshops. So here, for example, as a model, we talk about those who have a good understanding of the topic, who have good connections, who have good control, or some diversity along those lines. You need to have people who have diverse experiences around the topic to be there. Another way of segmenting the audience would be along the lines of who has an impact on solutions, how much decision-making power does the individual have, and how near or far are they from implementation and stakeholder influence. So just to give you an idea of 4 groups here, if you want to go after those who have high impact and high decision-making power, but are near the proximal to the stakeholder influence, then you may want to go with ensuring you have the money brokers and the family members attending your co-design activity. If you want to go after the same group, but they're far from the implementation, then you want to capture that segment. You want to have financial sector representatives attending your activity. Similarly, those with low impact and low decision-making power, and if they are near the proximal to the implementation, such as residents residing in the same community or village or city, should be attending 1 or 2 representatives in the activity. And those who are far could be people who are slightly farther from the community, but have an understanding of digital financial services to attend your activity. So you're ensuring that these 4 groups or 4 segments are represented, 2 or 3 people from each in each activity of your co-design. Step 4 is sensitizing. This is the step when you are starting with some warm-up activities, because many people who attend a co-design activity may not know each other. So you want to start with some activities that makes them comfortable, introduce each other, how they are experienced or not experienced in regards to the topic of discussion, and warm up so that then they can dive deeper into brainstorming for solutions that are to follow after a few minutes. So the objective of this step of sensitizing is to ensure that the people who are attending the co-design activity fully grasp and understand the context, the topic that we are about to discuss, and they're also abreast with identifying gaps and opportunities that exist in regards to the topic, let's say, of digital financial services. Step 5 is about facilitating. I cannot emphasize enough about the importance of a good facilitator who is is carrying out three things simultaneously: telling, enacting, and making. So he or she is providing information, delivering information based on the insights gathered from the systematic reviews, interviews, and surveys conducted in the resourcing stage, passing on that information. But that's just the first part of facilitation. The second part is to enact, to ensure that the people who are attending the workshop are understanding, enacting the role of a person who is representing themselves and people like him or herself. And of course, and then is the enacting, of the making, which means to brainstorm ideas, to come up with new solutions, co-create new ways of addressing an old problem, so that people in our context adopt digital financial services. So needless to say, like a focus group facilitator, even in co-design activity, an effective facilitator is the one who is open to ideas, who's focused on outcomes and processes, who is neutral in the discussion, doesn't give away his or her bias to people's opinions, ensures that diverse set of individuals are engaged in the whole discussion area, and ensures that the logistics, the climate, the environment, the ground rules are followed as they should be, so that everybody remains engaged throughout the process. Remember, facilitator is not just one person. You also need the main facilitator, but you also need 3 or 4 sub facilitators, each managing a table. And that's how, as a team, you ensure coherent, good, productive, rich discussion throughout the session. The last 3 slides, I want to focus on the data that we gather, the insights that we gather from co-design. What do you do with them? It's very important that you capture these notes through transcription, by taking down notes physically or also audio or visually. Bring them together, integrate them, making sense of them, and ensuring that those insights are useful to the climate, the social change efforts that are to follow after the co-design activity is completed. So the next step, of course, is to gather all this information, integrate the insights, and to then transform them into ideas that can be developed into something that can be developed further, implemented into the society, pre-tested them, and evaluated. Data analysis can be done in a variety of ways, qualitatively and quantitatively. So qualitatively, one could use a phenomenological understanding or approach to understand what are the meanings that are coming up from the discussion that we had in the co-design activity. You could use thematic analysis. You could use narrative analysis to arrive at main themes, so that we can categorize all these disparate sense or ideas, the insights that we have gathered from 7, 8 co-design workshops into a coherent whole of maybe zeroing down on 3 or 4 ideas that make sense. So this approach is very useful. You could also code them quantitatively and then transfer them into a quantitative arena, and then analyze them using basic statistical techniques like descriptive analysis or simple inferential statistics like chi-square or t-test. Don't need to get too deep into the qualitative and the quantitative analysis at this stage, because what you need is good ideas bring together, getting an essence. But the more important point is to how do I make sense of this data so that I can transfer them into some viable solutions. And once you have a brief understanding of what those solutions could be, that is when you go back to some of the key stakeholders, have a discussion with them, have a debrief with those influential parties, and see which of these solutions really make sense. How do I take it further? What kind of capacity do we need to build? What kind of resources do we need to bring to bear so that they can be taken forward successfully? This is the time when you really go deeper into your insights from the initial preliminary data analysis into deeper insights at this stage with the help of the stakeholders, so that then they can be now taken to the next step of finalizing 2 or 3 solutions that could be further pre-tested and then implemented and evaluated. With these words, I would now like to bring forward Ms. Ayushi Mishra from MicroSave Consulting to talk more about digital financial services and various strategies.
Thank you, Samir. As Sean highlighted earlier, digital transformation plays a critical role in fostering inclusive growth and development. The adoption of digital financial services is a key driver of this change. Now let's take a look at some numbers that highlight the tremendous growth DFS has experienced in the APAC region recently. So, digital payment transactions in the APAC have been growing steadily at a compounded annual growth rate of 6%. By 2030, the region is expected to hit 427 billion USD in digital payment transactions. Smartphone adoption is a major enabler of this shift, with 62% of the APAC population now using smartphones. This has opened doors to greater access to DFS. Moreover, 64% of the APAC population has internet access, which is pivotal in driving the digital economy forward. In the past year alone, 88% of the APAC population made at least one digital payment, which marked a significant year-on-year increase of 69%. Credit card penetration has also seen a noteworthy rise, moving from 13% in 2021 to 29% in 2022. India's Unified Payment Interface, which we know as UPI, has been a standout performer in the APAC region by processing an astounding 89 billion transactions in 2022. Meanwhile, China's Internet Banking Payment System, which is also known as the IBPS system, processed more than 17 billion transactions last in 2022. So these numbers not only showcase the rapid transformation within the APAC, but also emphasize how digital financial services can serve as a key instrument in bridging gaps and driving inclusive growth across diverse populations. As we know, the growth of digital financial services presents significant opportunities for fostering financial inclusion. But low and moderate income customers face distinct challenges in adopting these services. To understand these barriers, we can use the Elephant Path Rider framework by psychologist Jay Haidt. Here, the rider symbolizes the rational mind that makes logical decisions, while the elephant represents the emotional side, our fears and habits. The path reflects the external environment, including infrastructure and available resources. Now imagine the rider atop the elephant, seemingly in control. However, if the rider and elephant disagree, the more enormous elephant, driven by emotion, takes over. For LMI customers, the rider recognizes the benefits of DFS, such as lower transaction costs and improved access. Yet, trust issues arise as many worry about fraud and security risks. Additionally, limited digital literacy can weaken the rider's influence. The elephant, influenced by habit and fear, often prefers traditional banking methods. Concerns about data privacy and a lack of financial education further impede adoption. The path complicates matters, as many LMI customers have limited access to technology and perceive high costs and inadequate customer support as barriers to DFS. So to promote DFS adoption, we must align the rational desires of the rider with the emotional needs of the elephant while clearing the obstacles in the path. This approach can lead to more effective and inclusive DFS solutions that resonate with the LMI segment and drive meaningful behavior change. Now, if we are to understand why LMI customers fear engaging with digital financial services, we must first understand the significant risks they face when they attempt to adopt DFS. These risks can be categorized into three main issues as per MSc research. Trust, as we know, is essential for confidence in financial services, particularly digital ones. However, deceptive practices such as bundled products, hidden costs, and fine print can erode trust and make it hard for LMI customers to make informed choices, in the process increasing their hesitancy towards DFS. The second is comfort with technology. Many LMI customers struggle with technology, particularly complex interfaces and processes, which can feel overwhelming. This discomfort deters adoption and raises the likelihood of errors and missed opportunities when using digital platforms. The third, of course, is user interface design. Poorly designed user interfaces can further complicate DFS usage for LMI customers. Non-intuitive and inaccessible interfaces pose significant challenges and lead to increased reliance on informal or traditional methods. Beyond these perceptions, there are real risks which exist, particularly concerning fraud detection. Many LMI customers overestimate their ability to recognize fraudulent activities, which leaves them vulnerable to scams, especially with the rise of illegal digital lending applications, also called DLAs. As per the RBI Working Group report of 2021, 600 illegal DLAs operated in India, accounting for 54% of all the financial apps. In Indonesia, the Financial Services Authority blocked 1,350 fintech platforms in 2019, and in China, data from the Chinese Banking Regulatory Commission in 2016 revealed that around 40% of all P2P lending platforms were identified as Ponzi schemes. Many consumers use digital lending apps without fully understanding their legitimacy or risks. Limited digital literacy makes it hard for them to navigate complex interfaces, increasing their discomfort. This lack of awareness heightens their vulnerability to losses and debt traps, as they may not grasp the full terms of loans. Some specific risks in digital lending include high interest rates. Many online loan consumers are blindsided by exorbitant interest rates revealed only after taking out loans. And then violent debt collection. There have been alarming reports of violence and intimidation which have emerged around debt collection, particularly affecting those who may lack the resources to challenge unethical practices. These challenges highlight that while DFS can enhance financial inclusion, unethical practices and vulnerabilities to fraud present substantial barriers for LMI customers. Addressing these risks through improved design, education, and trust-building measures is critical for creating safer, more reliable DFS that LMI customers can use confidently. Since trust plays such an integral role in the adoption of DFS, let's now turn our attention to how FSPs can build and strengthen trust in DFS, specifically through MSC's trust framework. The framework outlines 5 key pillars that FSPs could focus on to foster trust among consumers. Trust starts with clear communication about products, prices, and processes. FSPs should ensure full disclosure and avoid hidden fees or deceptive practices. When customers clearly understand what they are signing up for, they are more likely to engage with DFS. Transparent pricing and terms build confidence in financial decisions. However, despite regulations, some FSPs still use complex, opaque pricing structures that confuse consumers and lead to mistrust and dissatisfaction. Further, FSPs should design products tailored to the needs of LMI customers and use marketing approaches that resonate with them. For example, Grameen Bank in Bangladesh emphasizes community engagement and personal stories, which aligns with its audience's values. By offering small loans without collateral, they make financial services accessible to those who lack credit history. Additionally, compliance with local regulations assures customers that products are provided by trustworthy institutions operating ethically. Complex user interfaces can deter LMI customers from adopting DFS. For example, a major bank in India had launched a mobile banking app designed to attract tech-savvy young customers. However, the app did not incorporate essential accessibility features such as voice-over support and large text options, making it difficult for visually impaired users to navigate. This oversight not only limited the app's usability for those with disabilities, but also impacted the bank's image regarding its commitment to inclusivity. FSPs can build trust by creating simple, intuitive interfaces that empower users. Seamless and accessible delivery enhances positive experiences, further strengthening trust in the platform. Security is crucial for trust, as we know, especially with rising concerns about data privacy and fraud. FSPs should invest in innovative security measures to protect customer data while also educating customers on account security and fraud detection. ANMs in India are increasingly employing AI/ML solutions to monitor agent transactions. When customers feel their data is safe, their trust in DFS increases. Further, effective Grade-1 solution mechanisms are vital for maintaining trust. FSPs must ensure timely support when issues arise, with regular monitoring and quick responses to customer complaints. Efficient issue resolution builds a reputation for reliability and fosters broader DFS adoption. The Experian Global Identity and Fraud Report of 2021 cites that 50% of companies increased customer support in 2020, yet only 25% of customers received quicker responses or were able to connect with customer service. As we pursue the idea of co-designing solutions, a collaborative and responsive approach is essential for helping LMI consumers maximize the benefits of DFS. As we have seen, DFS has the potential to transform their financial landscape by providing the LMI access to banking, savings, credit, and insurance. To ensure effective utilization and benefit, we need targeted strategies. The first step is to raise awareness and communicate the value of DFS. We must educate users on its benefits, tailoring messages to highlight how these services can positively impact their daily lives. By demonstrating how DFS can save time, reduce costs, and streamline transactions, we can encourage greater adoption. Further, a positive user experience is vital for digital platform adoption. Seamless, intuitive, and secure transaction processes for payments, savings, and credit build confidence and encourage repeat use. In the APAC region, FSPs are enhancing user friendliness for LMI customers. For example, bKash in Bangladesh simplifies registration with multiple sign-in options for less tech-savvy users. But there are exemplars from other sectors also. For instance, Grab, which is a food delivery app whose inclusive design tailored to local cultures, has made GrabFood Southeast Asia's top food delivery platform with a 10% monthly increase in its user base. When customers feel comfortable using these services, they are more likely to incorporate DFS into their daily financial activities. The third is to build digital capability and foster trust among the low-income users, and this is vital as many may lack the necessary digital literacy. Offering training and support through in-person workshops, digital tutorials, or community programs can enhance user competency. Additionally, an emphasis on security and privacy is crucial. Customers need assurance that their information is protected. By fostering both skills and trust, we can establish a solid foundation for sustained DFS usage. The next point is expanding digital financial services infrastructure, which is the key to widespread adoption. Reliable systems across geographies and sectors, supported by better internet access, mobile networks, and rural agent networks, will boost accessibility and use. DFS must be seamlessly integrated into daily life. For example, bKash in Bangladesh has built an extensive agent network for easy cash transactions and focused on mobile network reliability, thereby successfully embedding DFS into the routines of millions, particularly in rural areas with limited banking options. And finally, a collaborative ecosystem is essential for driving innovation and maximizing the benefits of DFS. By partnering with banks, fintechs, telecoms, and other stakeholders, integrated user-centered solutions can be developed by financial service providers to meet the needs of low-income consumers. These collaborations facilitate streamlined processes and innovative services that respond to market demands. The adoption of a collaborative and targeted approach will empower individuals to leverage the financial opportunities offered by digital services fully, promoting financial inclusion and enhancing their economic well-being. Now, I will hand it over to Dr. Peter Morgan from the Asian Development Bank Institute, who will discuss the role of international agencies in enhancing the potential of DFS in emerging markets and also discuss our ongoing study in Bangladesh.
I'm Peter Morgan. I'm going to talk about the role of international agencies in enhancing the potential of DFS in emerging markets. I'll focus on the Asian Development Bank as an example. For example, they can fund for expansion of digital infrastructure, such as for internet connectivity. They can carry out funding for financial literacy and digital literacy programs, and they also carry out research on financial inclusion. Now, about my own institute, the Asian Development Bank Institute, we've been carrying out research on the determinants of and effects of use of DFS, and we're now carrying out a randomized control trial on the effects of intervention on use of DFS in low-income households in Bangladesh, which I'll talk about more in detail later. Let me give you a couple of examples of investment projects by the ADB. First, the Asia Pacific Remote Broadband Internet Satellite Project entails the construction, launch, and operation of a shared geostationary Earth orbit high throughput satellite featuring Ka-band technology, which will be dedicated to low-cost, high-speed, easily accessible broadband internet in Asia and the Pacific. And this will increase the availability and quality of broadband internet service in that region. Second, in the Philippines, they're carrying out the ISON Nationwide Digital Connectivity Project. This involves a Philippine peso 4.8 billion senior secured project finance loan comprising 2.4 billion through ADB and another 2.4 billion through parallel loans to support the development, construction, and operation of up to 800 telecommunications towers in the Philippines. Here's an example of the ADB's research on financial inclusion. It's the project on unleashing Asian female entrepreneurship with digital technology. This knowledge and support small-scale technical assistance project will carry out new research and produce knowledge products on female entrepreneurship in the context of digital technology in developing Asia. The project aims to address the following root problems. First, lack of empirical analysis and indicators on the constraints to female entrepreneurship in DMCs. Second, lack of research on the link between digitalization and female entrepreneurship, as well as the factors that limit access to digital technologies by women. And finally, lack of knowledge on the digital gender divide among entrepreneurs. And here are some examples of research by my institute, the Asian Development Bank Institute. I won't go into details on these, but you can see the references here. Now let me talk about our randomized control trial on the effects of intervention on use of DFS in low-income households in Bangladesh, which is a joint project with the Griffith Asia Institute. So the first stage is the baseline survey. We collected data from 1,000 households in Bangladesh and another 1,000 in Indonesia. Indonesia represents a relatively advanced digital economy, whereas Bangladesh is more of an emerging digital economy. So collection took place over a 4-week period during March, April of 2023. Data were collected from 81 villages in Bangladesh and from 87 villages in West Java of Indonesia. These locations were targeted due to their high proportion of low-income households, but still having good internet connectivity. A total of 57 questions designed to gather insights on demographics, household makeup, livelihood, financial literacy, attitude toward digital technology, and usage of DFS were asked. The criteria for the respondents were minimum age 18 years old, maximum average household income of the local equivalent of $300 US, having regular access to a smartphone and a stable internet connection, and being the primary money manager of the household. Here are some descriptive statistics from the survey. So for both Indonesia and Bangladesh, in both cases, a high percentage, around 80% preferred cash, although about half in Indonesia and about 3/4 in Bangladesh did have e-wallets. The representation is about roughly half male, female. Average age ranged between 35 and 40. Here's an example of the data collected from the survey. In this case, it's the use of mobile banking and mobile payment apps in Indonesia compared with the income groups. And we find an interesting difference that the users of mobile banking apps tend to be concentrated in the higher income groups, whereas the users of mobile payment apps tend to be more concentrated in the lower income groups. Here are some results of our regression analysis on the determinants of mobile payment application use in both countries. Interestingly, the financial literacy score was positively correlated with mobile payment app use in Bangladesh, but negatively correlated in Indonesia. That suggests that mobile payment apps might be a bit of an inferior good in Indonesia. On the other hand, having a university degree was positively correlated with mobile payment app use in Indonesia, but not in Bangladesh. Now I'll describe phase 2 of the project, which is the randomized control trial. For the trial, we selected 230 households running small businesses in Bangladesh, half being the control group and half the intervention group. They have mobile phones and payment apps, but only infrequent use of DFS. So diaries and the technology adoption model surveys will be collected over a 1-year period. The intervention consists of instruction on the availability of DFS and how to use apps to access them. And the objective is to determine if the intervention group shows more progress in the use of DFS in a variety of dimensions than does the control group. This figure is a schematic of the project. So first we see the intervention and then the adoption of digital payments as the main impact. And we monitor the adoption and the outcomes on various dimensions. So first would be the use of informal financial services. Is there a shift toward more formal services? Second would be confidence and trust in technology. Is there greater use of technology? Third would be cognitive bandwidth. Is there impact on financial decision-making? Fourth, resilience to shocks. Fifth, household poverty. Is there an improvement in their well-being? And then finally, peer advocacy. Is there enhanced trust in usage of digital finance? And empowerment. Is there enhanced involvement in financial decision-making? So that ends my presentation. Thank you very much.